Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Willem Middelkoop, author of several books, including The Big Reset, which was translated into 8 languages, including Arabic and Chinese, former journalist, and founder of the Commodity Discovery Fund. Willem, thanks for joining me today. How are you?
Well, great to be back. It has been a while, so enough to talk about.
Absolutely. There's always a ton to talk about. And I think, let's say most consequentially right now, I'd like to start by talking about what you think a peace deal in the Ukraine could mean for the markets. What markets do you think are trading possibly at a premium because of that?
Actually, I don't think it will be such a major event because it will bring more or less a frozen conflict because Russia and Ukraine can never be friends as long as the Putin regime is there. I don't think gold is over 3,000 because of the Ukraine war, although the Ukraine war showed the world that the US is ready to use the dollar as a weapon. So the weaponization of the dollar became much more serious. The weaponization of the dollar has always been there, but now it was so clear out in the open by confiscating or the financial reserves or locking them. Because of the weaponization of the dollar, I think the other side of the planet, let's say the BRICS side of the planet, the eastern side, choose to weaponize gold. And this hasn't been talked too much about, but I think gold's being weaponized. You said in the intro that I'm the author of The Big Reset. The subtitle of The Big Reset is The War on Gold and the Financial Endgame. We're in the endgame now. That doesn't mean this is the end of the world, but it's the end of a financial system centered around the US dollar since the end of the Second World War, which is well over 80 years ago. We all know that on average, every 92 years, we're in for a big system change, monetary system change. Every 80 years, the fourth turning, we're in for a, well, for a reset of the system, also from a social point of view. Mm-hmm. So there's so much happening now, which is way bigger than the Ukraine war. In a way, the Ukraine war is a proxy of the larger war between the US, West, and China, the East, or BRICS. Mm-hmm. And this was the main thesis of the Big Reset, that we were reaching the end phase of this dollar system with the US as world's hegemon. And if you read the epilogue, the book can still be downloaded for free at our website. And if you read the epilogue, which was written around 2014, I wrote you can have 2 scenarios. Or the East and the West will keep working together to bring the international monetary system to the next phase in cooperation. Or we'll get a conflict scenario, and wars have been started for less than the end of a monetary system after 80 years. And now we went from this era of cooperation to confrontation. And it's much harder for me to predict what will happen now because we have so many moving parts.
Mm-hmm. Well, certainly we can't, let's say, predict the micro movements, but I think it's relatively clear what the long-term outcome of this is going to be, right? And as we'll get to later, what that means for the dollar, what that means for commodities in general. But, you know, there's been lots of volatility in policy and especially in conflicts already in 2025 that have had some effects on the markets. Do you see the tariffs as something that will ultimately be beneficial for the US once these tariff rates are actually understood and kind of solidified?
This question is just like your previous question. It's an important question, but it's just one small part
Mm-hmm.
of all these moving parts. And in a way, it's a proxy. It shows you have a, well, let's say weird, strange leader in the US, a weird president, which aligns perfectly with the end of an era. Look at all the other empires which failed in the end. The leaders in the end weren't the most stable and strong ones. So Trump is using all these bully politics. He needs to pressure all his trading partners more and more in a way which make all these trading partners feel very uncomfortable. And in a way, he's making enemies like India and China are natural enemies, but he's bringing them together because of all the tariffs and all the bullshit he's confronting to all these BRICS countries. And even Brazil is openly calling and doing calls with India and China because they want to unite even more because of all these bully politics by Trump. So in a way, it proves we're in the end game, and the hegemon, the US as leader of this financial system, as leader of the free world, is losing support even faster by applying more and more pressure. It shows the US is weak. It doesn't show the US is strong. If you're strong, you don't need this. And why is the US doing this? Because they know it's the end game. They know the budget deficit is that large. Something needs to be done. They know there aren't enough foreign buyers of US treasuries. So now they even have to promote stable coins because that's the buy of last resort out there. So now you reach a point where Bitcoin, which should be a competitor of the system, which should be an enemy of the financial system, Bitcoin is now needed to support the financial system, because Bitcoin and stable coins is a central part of the digital economy. And the US is front running it. And you have a president with his family front running and milking the system. So it's such a weird time. And it's such an interesting time. But don't forget, the real crisis still has to start. The real sovereign crisis still has to start. The real currency crisis still has to start. The real social and political crisis still has to start. And the real economic crisis still has to start. And that will be all starting to unfold in the next few years. And I think that's the winter phase of the fourth turning stuff, the famous book by Neil Howe. We're in this crisis period where you get wars and tension, and the wars in the Middle East and the war in Ukraine are proxies for me for that larger conflict. Mm-hmm. It's all about who will rule the world for the next 80 to 90 years.
Willem, a big part of the goal of the tariffs obviously will be reshoring many of the facets of manufacturing for the US. Do you think that this is going to take a lot longer to implement on a meaningful scale than Trump's term as president here?
You know, I'm an investor in the mining world of mining and commodities. Mm-hmm. We see the US and also the EU pushing investors and companies in our industry to start finding new copper mines within Europe, within the US, But we all know to open a copper mine, even if you cut the red tape, will take at least 10 years from discovery. So I don't think the US will have will have 10 years before they'll need that copper. So I think it's a stupid idea. We can decouple from China as the West. And China understands time is on their side. Russia understands time is on their side. But it shows the desperation, one could say, that the US is willing to gamble with the world economy at stake just to prepare for this last and final fight with China. And my biggest worry is that it's not only an economic fight, it's not only this proxy, you don't only have these proxy fights, but you'll have a real fight, a kinetic fight somewhere in Asia. And when you study the language coming from the Pentagon and the Secretary of Defense and all these think tanks, it's all pointing to a huge conflict around 28, 29.
So, Willem, what do you think this means for, let's say, the domestic side of mining and commodities? Do you think that there is enough runway within Europe, within the US, within even Canada, to be able to develop some of these mines for meaningful production? Or is investment in some of these areas, in your view, kind of a moot point?
Just before we started this conversation, I told you I've been investing in this industry as a private investor for the last 20 years, as a fund manager for the last 16 years. And in the first 18 years, I never heard from the Dutch State Department. And now in the last 2 years, we get calls every quarter if we want to join them for brainstorm on mining. And suddenly they all want to be active and to decouple from China. But it's such a weird idea, as I explained, because you need so much time. So it's too little too late. But it's good for us. It's good for our business. We're up 33% this year. You see commodities are getting sexy and more interesting for institutional money to invest in. But I think this is the very first inning, because all this pressure from the Western governments to support their own mining industry, it helps to bring some eyes to the story, and actually it helps for this perfect storm to develop, because also already without this government support, we had this higher inflation, which makes a flight to commodities one of the better ideas. You had the supply and demand imbalances. More and more of these metals and materials are seeing supply deficits. Copper will be in the supply deficit next year. We've seen supply deficits in silver for years and years. And then you have this currency debasement, and money is actually dying since the start of the Federal Reserve over 100 years ago. The dollar, the purchasing power went down 99%, and people are starting to become aware of this, also about outside our industry. So you have this perfect storm developing. So we're very happy with everything Trump is doing with his tariffs and the reshoring. But overall, it shows we're in this endgame, and things will get much weirder. And I think the economy is still quite strong, although it's getting worse every day. Look what Powell said in Jackson Hole: they need to cut rates now. If you spend some time in the US, and when you drive outside the big cities in the more rural areas, you understand the business and the economic conditions aren't that great. So I'm afraid we'll enter a more serious downturn soon. And then the big question is, What will central bankers do? And I think we know the answer. Central bankers can do only one thing, is print more money. And that's when the real fun starts for people in our industry.
Well, Willem, you mentioned to me before we hit record here today the idea that we're starting to see this movement. We're starting to see some momentum start to gather within, especially the TSX Venture Exchange, which many of these mining companies are listed on. And you compared that to this idea of the small bull market we had in 2016 and even the bull market we had, or not necessarily bull market, but the V-shaped type recovery we saw in 2020. So do you think that this is a far healthier type of market setup at this time than either of those two examples?
Yeah, this is way different. This is way different. And we have this discussion also in our funds. And some people are ask me, shouldn't we take profit now? Because the rallies in 2016 and 2020 only took 5, 6, 7 months. And then you needed to start hedging again. Mm-hmm. But if you look at the bigger picture, we started our commodity discovery fund in 2008, the summer of 2008, just 4 months before Lehman. That was the top of the last cycle valuation-wise. Then you had this huge collapse after Lehman crash. Then you had a recovery rally, and then you had a very long bear market until the end of 2015. That was an ABC correction. Mm-hmm. And that took, after the top, from top to bottom, like 7 years. Then you had the first move up in 2016. From an Elliott wave perspective, maybe you won. And then you had a retest in March 2020, when we went all the way back. And I think the Toronto Stock Exchange Venture Index, where all these exploration and smaller mining companies are listed, I think it even made a new low. And then you had another retest in 2024. So valuation-wise, we're still at the bottom. Of course, the GDX is up a lot. HUI is up a lot. The gold producers are up a lot. But if you look at the basket of exploration companies, they just started to move. Actually, they were just breaking out in the last 2-3 months. And we always have this starting point, the summer of 2008, when our fund started. Our benchmark, the Toronto Stock Exchange Venture Index, is still down over 70% from that date. So there's so much upside, there's so much room to recover. And to come back to your question, I think this is the real recovery after the full start of 2016 and the full start of 2020. And don't forget, in 2022, we reached the end of this bull market in treasuries. Interest rates have been declining for 40 years between 1980 and 2020, 21. So that was the end of the bull market in treasuries. I think that changed a lot. We had this huge inflation. People are aware of inflation. They are aware of the loss of purchasing power. And people are looking for alternatives, even institutional money, who ignored commodities for the most of the last few decades. They're looking at commodities nowadays.
Well, and with that perspective of starting your fund in 2008, do you see that as, or the time since then, as a real time of being able to build this base, build this book of commodities, book of mining shares, however we want to say that, was, do you, in some ways, was that a valuable time to actually start the fund to be able to build over this last,
15, 16 years?
I was going to say 15, 16 years.
In presentations, I always say it's the worst decision, has been the worst decision of my life to start in 2008. But it was also the best decision in my life, because in the last 15 years, we made many mistakes, like all investors do. But it was a humbling experience, which was good for me as a character. But it gave us time to study the world. while nobody was interested in commodities. We were touring the world, visiting deposit, checking out companies like you and your group have done. And there were so many bargains. And we really started to understand the fundamentals, the supply and demand fundamentals. And it's not just about gold, it's not just about silver. Lithium has its own market fundamentals, uranium has its own market fundamentals. And then you have the virtual gold, the digital gold. I called it virtual gold in 2014 in the big reset, and that's another hard asset as well. So that's a friend of gold. It's the brother of gold. And now after 17 years, almost 17 years in this business, and now this bull market is starting, I feel blessed because we have almost 200 million under management now. We have almost 2,000 high net worth investors. We know all these management groups now. We know the world of commodities. We know where the last scarce undeveloped mining projects are. So I think we will do very well in the bull market.
Mm-hmm. Well, I think, interestingly, to be able to survive through that time, that really speaks to either your persistence or your ability to, A, access capital, and B, also to learn from those lessons that you were given over that time.
Yeah, well,
right?
we have the most loyal investor base, and most of them, 95%, is from the Dutch-speaking countries.
Mm-hmm.
And I think it to understand that is to understand that I've been a journalist for 20 years. Look, if I would be in this world just to make money and become rich, I wouldn't have been a journalist for 20 years. So people understand that it's not all about the money for me, but I like the hunt, I like the research, and I've never been really depressed in all these years.
Mm-hmm.
I always knew that we were in this downturn, and downturns can take a long time, sometimes 10, 20 years, but there's always an upside. And the great thing about a huge bear market is you have so much value. There's so much value to be found. And as long as we still had inflow, we had net inflow every year since inception. So we were never forced to sell, because you know what happened in the past with Eric Sprott and the Pine Tree funds, who were all riding this bull market until they grew to 1 billion under management. And then when the downturn came, they had redemptions, and then they needed to sell, and it killed their funds. And fortunately, we never reached that point. So we never were just distressed sellers. And now I think we had a negative spiral in our industry, and now we get a positive spiral. And if you look at past bull markets, 100% gain, that's just for starters. I looked at the valuation, even for the seniors. Look at Newmont and Barrick. They just started to recover last year. The price earnings of both of them is around 10. Mm-hmm. Not future earnings, past earnings. It's 10. In the past, even without a strong bull market, a serious gold miner was valued at 25. Apple is valued at 25 price earnings. We call that cheap in tech. And so there's so much value to be found. There's so much upside. And the gold price started to run when it crossed 2,000, and now it's 3,500 almost, but it won't stop here. And look at past bull markets. My long-term target, it used to be 5,000, it's $8,000 now. And I wouldn't be surprised to see gold over 10,000 in the next 10 years, because as I said, a real currency crisis is yet to start.
Mm-hmm. Well, your point about loyalty within this business is really interesting, and that's excellent to hear that you've had some really loyal people and investors around you. And kind of translating that to the idea of gold and about these hard assets, as you said earlier, I think is extremely important to understand and to really those assets and those relationships are what create real value in this world, right?
Yeah, and also I think investors value the fact that we've been consistent in our analysis. Our timing wasn't perfect. Our timing was awful. But we've been consistent in our analysis, in our story that we're reaching the end of this US centered, dollar centered system. And we received quite a lot of feedback in the last few months, last year, when people say now finally it's all starting to happen. People are not stupid, especially investors. Investors aren't stupid. We just did a survey among investors and people who follow us. These people on average have, well, $500,000 in net worth. Most of them are independent, they're self-employed, or they're pensioners. They understand they can't trust the banks anymore for financial advice because banks will only sell them their products. So they're looking for independent analysis. And your platform, Tom, is one of the best. Not to be friends with you, but I listen to your platform every week because it's one of the best shows which bring independent, smart analysis of some of the brightest minds. And the group out there who wants to be independent of the system, who has enough money to survive everything, every scenario, when they play it smart, when they diversify enough. We never want people to invest all their money into our fund. We always say 10, 15% maximum, because we always promote 25% in physical gold or silver, 25% in real estate, 25% in equities, which could be our fund of other funds, 25%, then keep that as liquid as possible, cash or Bitcoin. And Bitcoin being the fastest horse in the race is very tempting, but a lot of the older guys still don't want to touch it. But if you diversify in that way, you can survive every scenario, but you need to be out of the system as much as possible. But you don't need to fight the system. You should understand the system. And I'm investing some money in Dubai. I'm investing some money in Switzerland. And I get letters from my bank why I'm sending money to Dubai and Switzerland. And I'm always glad that I get these questions, because it means I'm still allowed to do it. And I'm still allowed to answer the questions. The next phase is you aren't allowed to send money abroad anymore. So we'll move to more financial repression. It isn't there. Well, the first signs we have seen with the debanking and the closing of the on and off ramps for Bitcoin. So you know what's coming, but you still have time to prepare. But it's easy for guys like us who have a bit more money, and it's very difficult for people who are just on a normal salary and who don't have any spare assets, because for them it's very difficult to diversify.
Well, I mean, that's an interesting thought or concept that I've been discussing with a couple of friends lately, of, this idea of basically deferred gratification, saving, investing, things like this. When in this era of cheap money, it's just so easy to look at everybody around you as a comparative and see what taking on debt means to their lives versus being patient, trying to be intelligent about this, trying to be strategic about it, especially in the commodity space.
Yeah.
I really hope for the investors in this space that this patience is going to pay off handsomely for them because of this patience and this comparison around them.
It's already working, and we meet many frustrated investors in our fund, but we never have them as enemies, because they always say, Willem, we also have real estate. We also invested in physical.
Mhm.
Many of them also have Bitcoin. So on average, they've done very well over the last 10 to 15 years. And you don't need to have all four parts to be winners every year. We also had a few years when real estate here in Europe went down after the Lehman crash. And now it was up a lot in the last few years. So, but if you have this diversification of real estate, physical, some Bitcoin, some cash, and some equities, I think on average you will do quite well.
Mhm.
And people have done quite well.
So, Willem, kind of going back to this idea of maybe capital controls, as you were mentioning, being able to still send money to Switzerland, money to Dubai, different places, is the implementation of this digital euro that has been announced in October and seems to be kind of wavering back and forth a little bit. Is that something that you're actively worried about, actively managing against? How do you see that starting to play out as, let's say, the first domino in this digital currency system that
Yeah,
a lot of us understand is coming?
it always surprised me that people reacted so strongly on central bank digital currency, which is quite technical to understand, but many people are scared as hell for central bank digital currency. And I always try to explain it's just one next level on top of a fiat money system,
Mhm.
in which you really build a all digital fiat money layer. So it's more of the same, and it only supports my thesis that you need to get out of fiat as much as possible. Of course, I keep some cash, but just enough to pay the taxes. You better keep your liquid assets in other forms.
Mhm.
Um, but if we study central bank digital currencies, I think the situation a few years ago was much more alarming, because then we were in the situation that you could say that most of the world was preparing for central bank digital currency, where government was totally in control on the money supply, but also on how you would spend your money, how you would be allowed to spend your money. And China was, of course, the best example. And then we knew the ECB was very active and pushing their engineers to be ready as soon as possible. And the Federal Reserve was on the same track. But now when Trump arrived, and that was the good thing about the Trump administration, although they're doing all this weird stuff now, but they stopped the censorship, with the big tech companies. That they stopped that censorship. They stopped the debanking. They stopped the fight against Bitcoin, but they also stopped central bank digital currency. Trump has made it very clear we won't have a central bank digital currency, and he's going the other route. He's going to the stable coins route, and the stable coins will be huge buyer of the treasuries. And I think for us as investors, but also as citizens who think our personal freedom is important, you're better off. Most people, let me be clear, most people are better off with this administration for their personal freedom than with the other side. And of course, what's happening with the immigrants, these people feel, of course, less freedom, and we've seen some appalling scenes where people are picked from the streets who have done nothing criminal. They might be illegal, but I think that's not a reason to start a razzia to pick them from the street when they're going to Walmart to get a house fixed for somebody who's paying for that. So I'm not a big supporter of the Trump camp, but I always want to point out we need to be fair. And one of my main worries was the censorship, which was creeping into our Western society through the big tech. And well, he solved that problem for 90%.
Mhm. Willem, you mentioned earlier this idea of a far bigger downturn coming. But when we look at the valuation of the equity markets within the US right now, does this show us that we're at near or at a top where we have the risk of an extremely serious and quick downturn, or what do you think that ends up looking like? Is it maybe a slower grinding downturn where we can have
Well,
more like a lost decade or 2 decades in the stock market?
what's your age, Tom? I'm
I'm 30.
63.
I'm 39.
Yeah. Well, I'm 63. I'm an old boomer now. I was around in the late 90s when we had the dot-com bubble. I wrote my first market commentary just for friends in the late 1990s. I published my first editorials in a Dutch local newspaper in 1999-2000, warning for the extreme valuations on Wall Street, warning that valuations were even higher than 1929. So I know a bubble when I see one. And since 1999, I learned a lot more. And actually, I wrote my first book, which was only in Dutch, in 2007, warning people for the huge bubble in US real estate and credit markets. So I've seen it all before. And when you follow me on Twitter, I post these graphs all pointing that we're very close to a top. But being very close to a top doesn't mean the correction will start next week. It might take another 12 to 18 months. But once we have topped in the major markets, if history is any guide, these markets can go down 70, 80% over the next, let's say, decade.
Mm-hmm.
That's the normal pattern. If you believe in Elliott wave patterns or just traditional patterns, but you can have all kinds of corrections. You can have the 1921 or March 2020 crash style, in which everything goes down in a few days.
Mm-hmm.
Or you can have a huge correction over, let's say, 2 to 3 years, which happened after 2000, between 2000 and 2003. Tech stocks came down by 80, 90%. Many other exchanges went down by 20, 30, 40%. So I'm watching this topping pattern like a hawk, and I will adjust our portfolio once I see what kind of correction this will be. And we're already starting to grow our cash levels. We're already starting to become less aggressive and more defensive, because we've seen in April this year how fast things can go down. If Nvidia is starting to correct, everybody wants to sell at the same time. So it's something to watch.
Well, everybody and every algorithm as well, right?
Yeah.
So
all these passive investors, it's scary. I don't know if you have had Mike Green on your show.
I have.
I think you had. Yeah, I think you had. Mike Green, he specialized on these passive investment flows, and he can explain this much better than I can do. But we all know this is not a stable, healthy market. This is getting very unstable.
Mm-hmm. Well, to that point, Willem, with Powell softening his stance on holding rates here at Jackson Hole, how does this create more fuel for maybe a further blow off top from here? Or is he possibly too late?
No, that's a great question. I think this will fuel the last move towards a blow off top, and I think you're familiar with David Hunter as well. He's a market analyst. He's even a little bit more boomer than myself. He's a little older. He has seen it all. He recognizes a bubble and a hype market when he sees one, and they all these all these analysts who know how to analyze a bubble in historic perspective. My favorite book is by Kindleberger, is The History of Financial Crashes. And that explains it so wonderful. Every generation has this mania phase where everybody thinks he has to be a day trader. Here in our office outside, there's some painters. We have this heritage building. It needed to be painted. And the young guy came up to me to ask advice because he recognized me. And he said, should I be a day trader or a swing trader? And then you know that we're in this, well, bull phase that everybody wants to be a trader and everybody thinks it's easy to make money. And as you might know yourself, but I'm a student of monetary history. Once in every generation, you get these huge declines, and then people will never touch shares for the next 10 or 20 or 30 years. So people should be careful a little bit.
Well, the Fed has also abandoned the idea of targeting their 2% inflation rate. What do you see as being the primary driver of inflation still at this time?
The debasement of the currency. It's the growth of M2. When people always ask me, how can you be so sure that the gold price will keep rising? Well, because I know the money printing will keep on going. As long as M2 is growing, I know the gold price is just a proxy of the money growth. It's just going in tandem. Sometimes it's with shocks. But if you look at the long-term graph, it just follows the amount of money in the system. And I'm afraid
to your earlier point, the US dollar versus gold since 1971 has devalued by 99%, right?
Yeah, that was the point I made earlier. And I'm afraid that in the next crisis, central banks will start to really flood the system because that's all they can do. And that's when we get the real currency crisis, which I spoke of before. So you get a sovereign crisis because countries might not be able to finance themselves anymore. So then they need to run to the IMF. The IMF still hasn't used their balance sheet, so they can print trillions of SDRs. And central banks will need to print trillions and trillions of new money to handle these new crises, economic crises. Why? Because if they don't print the money, you'll have social crisis, and you'll have political crisis. For people who are interested in these in these phases where the money system becomes unstable, I read the book When Money Dies a few times. It's on the Weimar hyperinflation. This crisis became so severe in 1922 in Germany after the First World War, they couldn't find any politicians willing to be in the next government because as a politician, you're responsible for the mess. I see, if you look at the quality of governments in the US, in the West, here in the Netherlands, we have a huge political crisis nowadays as we speak. The real smart people don't go into politics anymore. It's just the narcissist and the psychopath sometimes who love the attention but so you can have a huge crisis on a political level, on a social level. You can have riots on the street. Look at the social imbalance in Europe with all the immigration. People are starting to get really stressed, especially when you enter an economic crisis. So this explains why many of the rich people, you see the same in Canada, in the UK, in Europe, rich people are leaving for Singapore and Dubai. And the West, at the start of this talk, you said that is very uncertain what will happen next. One thing is certain: the West is in decline, and the East and the Middle East is on the rise, I think.
Well, and I think going back to that earlier point about patience and trying to be strategic, it seems like the the countries that have been more strategic, that have been longer term thinking, are, exactly to your point, on the rise.
Yeah, so it's always difficult for people to understand things will get unstable as long as something is stable, because it's so hard to imagine things are not stable. But we all know, and we all know these great examples. The Hurricane Katrina, when it arrived in New Orleans, even the police were seen plundering shops within 24 hours. Society can break down in 1 or 2 days when you have the right. I once saw a documentary I like to watch real crime on TV, one of my bad habits. And then there was this police officer somewhere in rural, in Manchester or whatever in the UK. And he said, people should understand we are the last line of defense. When we can't handle it anymore, it's chaos. And I've been a journalist and a police reporter myself in my younger years. And I knew in a big city like Amsterdam, on an average night, there were 20 police officers on the street for the whole city. So we always think it's very stable and we can handle everything. But as soon as you have a huge riot, Paris is a great example. We had this gang war somewhere in the south of France where gangs took the street and police had to run. So I'm not predicting this will happen, but things can go from stable to unstable very quickly.
So, Willem, because of this continuing inflation environment, are you seeing that commodities and hard assets are the only place to be positioned as we continue forward?
Well,
in this diversified manner that you mentioned earlier?
Yeah, but you should also add new assets like Bitcoin to that mix. I once said that Bitcoin is the best money ever invented, and I still mean that. Gold is wonderful, but the wonderful thing about Bitcoin is that you can store your assets location. It doesn't matter which location you use, it's out there in the cloud. So to travel with your assets, it's much better to have digital hard money than to have physical hard money, because it's you have to carry that. But I think you need a mix, and there are many alternatives. In a way, real estate is an alternative as well. I always tell people, if you put money in real estate, you put money outside the system. You don't rely on a bank to store that money for you. It's there on that physical location, and not that much can happen to it. Well, can go down in value, and of course the government can confiscate it, or nationalize it. But this hasn't happened many times. So we spend a lot of time thinking about scenarios which could develop. And this is like, if you have a company, if you run a company, you need to ask yourself, what is happening when we have a server crash, when our computer server crashes? What's happening when this office burns down? You need to have certain procedures, and the same goes with your money and your net worth. So you have to prepare and hope you'll never need it.
Well, and I think to that exact point, that's also shows us the importance of diversifying into other assets where, if you, as you mentioned, you have the server crash, you still have, let's say, 3 out of the 4 buckets where you put capital into those assets, right?
And that's why diversifying is so important. But for many people, diversifying is very difficult. For one reason is they don't have enough money to diversify, and they always want to make this killing. They always want to make the 10-bagger. So they go all in on an altcoin, or they go all in on one junior mining stock. And that's you shouldn't do that.
Willem, when you, as we're talking about that idea of not going all in on one mining stock, let's say, how do you also position yourself to take, let's say, buy a meaningful amount of these assets, as you mentioned, these rare assets that you know where they are? How do you take a meaningful enough amount, despite understanding that you don't want to be fully invested in any one particular place?
Well, that's the great thing about being an institutional fund manager, because you have all this money from all these people,
Mhm.
and you need to invest it. You need to invest it longer term, and you're less emotionally attached because it's not only your own money, but it's a bit more easy to sleep at night when things go up or down in a very fast way. And by being a fund manager, and you have this long-term view, and people stay with us on average over 5 years. So we don't see a lot of trading, because you can't trade in and out of our funds on a daily basis.
Mhm.
You can take money out on a monthly basis, and we're also highly regulated. So this means we're not allowed to own more than 10% of a company. It means one position can't be over, let's say, 7.5% of our portfolio. So by design, we need to spread our risk. And what we learned over the years, and like I said, we made many mistakes. But if you spread your funds over, let's say, 50 companies with the best risk reward ratio, so they have a good upside, but a limited downside, they can never go to zero. I'm willing to do this another 10, 20, or 30 years and sleep well at night. And that I want to sleep well at night, and I don't want to risk it all like we've seen with the pine trees of this world. So we agreed that we'll never put more than 30-40% in these high risk, high reward, illiquid exploration stocks. So we always also have the ETFs, we also have the side pockets, and we added some Bitcoin to the mix as well, and which is a nice stabilizer because it has its cycle of its own.
Mhm. Yeah, and that's an interesting point as well, in the idea that as an institutional fund, you can't necessarily take a massive position in something that doesn't necessarily have the liquidity that you would otherwise need to be able to exit a meaningful position for a fund like that, right?
No, when I see peers which have hundreds of millions only in exploration stocks, I think then you don't understand portfolio management and risk management very well. Because there are just too many examples that you can't get out when you get serious redemptions. And what we also have uranium in our portfolio. Uranium has another cycle than gold. So gold might be going down, but then uranium is going up, or vice versa. So you can stabilize your fund. When we started in our first years, we were way too volatile on the way up and on the way down. So you can bring these internal stabilizers into your fund by building these side pockets.
And understanding that, let's say, the correlation of these markets, right? Like you want, if you had perfectly uncorrelated markets, you could just rebalance at the top / bottom, right?
But as a resource fund, it's more difficult because the resource market is more one market. So we changed our prospectus a few times a bit, so we're allowed to do a bit more. We work more with options now. So writing options on your positions in majors is a great way to get some extra money. We use options a lot with our Bitcoin positions, which are new markets, but very well developed. And that's great by having started in 2008, having seen it all, and now reached a point in life and reached a point in the fund that we're more mature. And of course, we still like the 10 baggers. Every year we have 10 baggers, but not every position should be a 10 bagger. if we make 30-40% in a good year, that's okay. You don't need to make 100% and risk 80%. 80% drawdown, that's what I mean.
Right. Excellent, Willem. Well, as we wrap up here, is there anything that you'd like to leave our listeners to think about?
Well, we haven't spoken a lot about silver. Silver is overlooked. I think it's the cheapest asset out there. It's a monetary metal. It's a commodity. It's used in the industry. There's a huge shortage. And I can't see why silver shouldn't be trading over $100 within 5 to 10 years, and probably much higher. And personally, I own a lot more silver than gold.
Even just on a weighting basis, or obviously ounces wise, right?
No, but so
does that create a challenge for you when you think about trying to play the proxy of silver through the mining companies, because
they're not around anymore?
the rarity of having a pure silver play.
Names. Tom, give me 10 good silver names. It's hard to find 5 nowadays.
Exactly.
Even Wheaton Precious Metals used to be a silver streamer. It's 50% gold now. Companies as First Majestic are 50% gold nowadays. So it tells you we're running out of silver. There's no silver there for mines to invest. And the US have been playing these markets and manipulating the precious metals by selling all these futures through the COMEX. But that game of musical chairs is ending now. The price discovery has moved from west to east. You might remember seeing that graph on X, that the major price movements in the monetary metals are now in the Asian trading hours. It used to be on the Western, during the Western trading hours. So I think the musical chair game is ending, and one day we'll have this huge news coming from the physical metal markets that something blows up and somebody can't deliver. And I think the rise of gold and silver, what we've seen in the last 12 to 18 months, is just front running by insiders who know what's coming. And so we're in the very first inning, and things will start to get very, very interesting quite soon. And that's when the real big moves will be seen. Eric Sprott, I don't know anybody who studied the silver market better as an investor than Eric Sprott. He must be so frustrated because he put all this money in all these juniors, well, which starting to get a bit, but which haven't done anything good for him in years. And I wrote all the stuff he'd been writing in the last few decades. And he said a few times, when silver really starts to break out because of these fundamentals, because of the physical shortages, you'll see $100 silver within a week. Yeah.
Well, I also think that this is, a healthier market to, go up step by step instead of having these massive spikes, because you can base and build a company on, $40, $50 silver as we kind of ease up in price, rather than get these dramatic price spikes that we have, that so many people within the space have talked about.
I agree, Tom, but we haven't seen one market yet where there was a real physical shortage on the metal. Maybe palladium in 2017, and then palladium prices tripled within a year.
What about the nickel situation?
There was a very short spike because of one trader who was wrong, and then just like the Hunt brothers, they changed the rules of the game. What I mean is that industrial clients like Samsung or Sony or Tesla say they can't keep producing because they can't find the metal.
Right.
And that's when we'll learn what the market reaction is on shortages like that. And in a way, the rare earth metals have shown a little example, but that's such a small market. That's a 5 billion a year market, or maybe 10 billion a year. But what happens when copper gets real scarce, or silver, or nickel, or uranium? Uranium, that's a space to watch. Kazatomprom just said production will be down 10% lower than previous estimates. There's so much new demand coming for uranium in the next few decades. And we're specialized in new discoveries. Maybe there's one new discovery, but it's not a big one yet. You have next gen, and then so I can't envision a scenario where we'll have enough commodities for all that's needed in the next few decades. And that's when we'll start to make real money.
Well, Willem, I really appreciate you walking us through how you see these things, how you see this playing out over the next decade here. Of course, all of your writing and website is all at cdfund.com. I believe the book is there for download as well.
Yeah, you can download the Big Reset there for free. I also have, I'm active on Twitter, and I have my own Patreon account. I'll send you the show notes, the links for the show notes.
Absolutely. And of course, your X handle is at W Middelkoop.
Yeah.
Willem, thanks so much
Easy
for your
to
time
find.
today.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.